Welcome back to the Daily Crypto Roundup. It's been one of those weeks where the market reminds us how closely crypto still moves with the global economy. And yet, underneath all that noise, the foundations just keep getting stronger. We've had regulation shifts, major corporate updates, new liquidity data, and one of the clearest signs yet that the next wave of institutional adoption isn't just coming, it's already underway. Bitcoin held firm above $109,000 after dipping earlier in the week. Ethereum steadied around 3,800, and most altcoins are moving sideways after a month of volatility. But this week wasn't really about price, it was about positioning. Because behind the numbers, the structural picture of crypto looks more solid than it has in years. Before we jump into it, make sure you're following the show and leave a 5-star rating if you haven't already. It helps us reach more listeners, and it means we can keep cutting through the noise to bring you what actually matters. So, let's get into it. This week's stories are big ones. Coinbase has tightened its lead in the US market just as rivals push toward public listings. Tether revealed record profits that show how stablecoins are now the backbone of crypto liquidity. A new nominee for the CFTC is signaling a completely new era of regulation under President Trump. Meanwhile, the macro picture, from AI spending to interest rate fears, rattled markets midweek before buyers stepped back in. And through it all, analysts are already looking ahead to November, wondering whether we're finally setting up for a macro rebound. Let's start with the one story that shaped all the others: macro. For months now, traders have been obsessed with what the Federal Reserve will do next. And this week, uncertainty reached a fever pitch. The Fed's last meeting left investors guessing about when, or even if, the long-expected rate cuts will actually arrive. For crypto, that uncertainty translated into noise. Stocks wobbled after disappointing tech earnings guidance from AI-heavy companies, sending shockwaves across the broader risk markets. Crypto caught part of that downdraft. Bitcoin briefly tested 108,000 before bouncing. Ethereum slid below 3,800 but recovered quickly. Altcoins bled, then rebounded. Analysts called it a classic macro overreaction. Gareth Soloway from Verified Investing said, "You can tell we're at the tail end of uncertainty when markets overreact to every headline. Bitcoin's not in crisis, it's just tracking liquidity." And he's right. Every time investors expect a cut, money flows into risk assets. When it doesn't happen, that flow stalls. But the bigger story is that even without the Fed's help, crypto's underlying liquidity engine hasn't slowed. It's just shifted. That brings us to story number 2, stablecoins. This week, Tether, the world's largest stablecoin issuer, reported more than $10 billion in annual profit and $135 billion in US Treasuries under management. That's a staggering number. It means Tether now rivals small countries in terms of bond holdings. The company's quarterly attestation showed record income from interest on treasuries, confirming what analysts have been saying for months. Stablecoins aren't just payment tools anymore. They're yield-generating machines that quietly power the entire crypto ecosystem. Every time you trade on an exchange, mint a token, or provide DeFi liquidity, there's a high chance a Tether dollar is involved. And the more interest those holdings earn, the stronger Tether's reserves, and the safer the system becomes. CryptoQuant's head of research noted, Tether's profit model now links traditional finance directly to on-chain liquidity. It's basically the Federal Reserve of crypto, and it's printing. The key takeaway here is that stablecoins are no longer a sideshow. They're the plumbing that holds this market together. And with yields north of 5% on US Treasuries, issuers like Tether are benefiting from the same high-rate environment that's made risk markets nervous. Now, while liquidity was strengthening under the surface, another story unfolded on the regulatory front, one that could reshape how America handles crypto entirely. President Trump officially nominated Mike Selig as the new head of the Commodity Futures Trading Commission, or CFTC. For anyone who doesn't know the name, Selig's background is fascinating. He's a former attorney from the very agency he's now set to lead, but in recent years, he's become known as one of the most crypto-forward legal minds in Washington. He's written extensively on how DeFi protocols should be integrated into existing market frameworks, rather than outlawed. He's also been vocal about classifying most digital assets as commodities, not securities. If confirmed, Selig would mark a sharp pivot from the enforcement-heavy approach of past leadership. Analysts from JP Morgan called it the most market-friendly regulatory appointment in years. For context, the CFTC regulates derivatives and commodity markets, which means it oversees futures, options, and, increasingly, crypto trading platforms. If Selig takes charge, we could see fast-tracked clarity for stablecoins, spot ETFs, and interfaces that have been living in legal limbo. This is huge. It doesn't just mean fewer lawsuits. It means more product innovation inside the US. Think of how quickly things could change. US-based exchanges might get a green light to offer more advanced crypto instruments, and traditional brokerages could integrate on-chain derivatives directly into trading platforms. In short, crypto could go mainstream. Legally. It's not just optimism either. Industry insiders have been preparing for this shift. Coinbase in particular seems perfectly positioned to benefit. Which brings us to the next story. While everyone's been focused on prices, Coinbase has quietly solidified its position as the undisputed leader in US crypto trading. According to Reuters, the company's trading volumes have climbed back to their highest levels since 2021, even as competitors push toward public listings. That's partly due to regulation and partly due to timing. When other exchanges were fighting lawsuits or leaving the US entirely, Coinbase leaned into compliance. It became the default exchange for institutions, asset managers, and retail investors who wanted a clean, legal, and familiar interface. Now, as Trump's new administration warms to digital assets, Coinbase is set to become the gateway for a new wave of capital. But there's another reason analysts are bullish: diversification. Coinbase is no longer just a trading platform. It's building infrastructure, running staking services, custody for ETFs, and on-chain analytics. The company's earnings report this week showed that nearly half its revenue now comes from those non-trading sources. That's the kind of business model that survives bear markets and thrives in bull ones. Meanwhile, Coinbase's upcoming rivals, like Kraken and Robinhood Crypto, are eyeing IPOs of their own. But for now, Coinbase remains the heavyweight champion. Analysts at Bernstein Research said it best: Coinbase has achieved what Binance never could in the US. And that's legitimacy. Now, while all of this was happening, another quieter but equally important story was playing out in the background: the growing link between crypto and macro liquidity. We've said it before, crypto is no longer an isolated market. It's a liquidity-sensitive asset class that reacts instantly to global risk sentiment. This week proved it again. When AI spending concerns hit US equities, the Nasdaq dipped, and crypto followed. When Treasury yields stabilized, Bitcoin bounced. But what's interesting is how fast crypto now recovers from shocks. 5 years ago, a global tech correction would have sent Bitcoin crashing 30%. Now, those moves are single digits. That's the difference between a speculative asset and a maturing market. Institutional portfolios are now treating Bitcoin and Ethereum the same way they treat gold or high-volatility tech stocks. And when that kind of capital behaves strategically rather than emotionally, markets start to stabilize. Still, traders are watching a few key indicators heading into November. First, ETF inflows. While last week saw modest outflows from Bitcoin ETFs, data from BlackRock and Fidelity suggests new institutional interest is quietly picking back up. Analysts believe many funds are rebalancing portfolios for year-end exposure. Second, exchange reserves. On-chain data shows that Bitcoin held on centralized exchanges has dropped to a 6-year low. That usually signals two things: investors are moving coins into long-term storage, and selling pressure is declining. Third, stablecoin supply. After stagnating for most of the third quarter, stablecoin issuance is starting to rise again, a classic early signal of new capital entering the system. Put those three together: ETFs accumulating, exchanges seeing outflows, and stablecoin supply rising, and you get the setup for a potential rebound. But we've seen this movie before. The question is timing. How long before macro uncertainty gives way to renewed risk appetite? That's where the final story of the week comes in: the look ahead. Next week is stacked with economic data. We've got inflation prints, updated GDP figures, and fresh job numbers. Any of these could shift expectations around rate cuts or tighten conditions further. If inflation cools, the Fed gets cover to cut, and crypto rallies. If it stays sticky, we might see another round of sideways movement as traders wait for clarity. But either way, the underlying fundamentals are stronger than they've been in years. Regulation is turning from enemy to ally. Stablecoins are printing profits instead of controversy. Infrastructure is expanding, and every macro wobble now brings less panic and more patience. That's the hallmark of a market growing up. When historians look back at 2025, they might see this as the year crypto matured, not because of a price explosion, but because it survived everything thrown at it. A shifting regulatory environment, political turnover, macro uncertainty, and yet the core continues to build. So, what can we expect heading into next week? Expect volume to increase as we head into the new month. Expect volatility around the economic data releases, and expect more signals that the real bull phase, the one driven by fundamentals, is getting closer. Because the biggest story this week isn't any single headline. It's the fact that despite everything, confidence is quietly returning. The charts may not show it yet, but the sentiment has changed. And in crypto, that always comes first. Drop your thoughts in the comments, follow the show, and don't forget to rate it 5 stars if you've been finding these breakdowns useful. We'll continue to keep cutting through the noise every week, and as always, we'll see you at the top.